Today I'll discuss GDP, US GDP, and the piece I put out earlier in the week, but I wanted to also discuss other issues that I've been asked about during the week. The first is the Deutsche Bank, second is the outlook for Australian equities market, and I've received further questions on Trump versus Clinton. Firstly, the Deutsche Bank. Most people don't know that we narrowly avoided a banking crisis in Italy about 3 weeks ago with the reconstruction of the Banco Monte Paschi di Siena, which is the third largest bank in Italy and the oldest bank in Europe. It was originally incorporated in the 15th century. Now, the alternatives that were available at the time or spoken of were one, that it could be reconstructed by the Italian government, or two, that it could be reconstructed by bail-in. Now, this is under the current, this is the standard EU regulation. Bail-in means basically the bondholders and the senior depositors in the bank all get it in the neck, and that money is confiscated, and that becomes the new capital of the bank. Now, that, as you can understand, is extremely politically unpopular, but it is the standard position under the EU regulations. So, turning to the Deutsche Bank, obviously the Deutsche Bank has a problem. The German government says that it is not going to rescue the Deutsche Bank. So you would think that there would be only one alternative left, and that's the very politically unpopular alternative of bail-in. But there is one other. If we cast our minds back to 2008 and the financial crisis, we'll see that what the Fed did in similar circumstances was organise takeovers of troubled banks by other larger, more healthy banks. And the one that comes to mind is Bear Stearns, which was taken over by JP Morgan. There are others. So it occurred to me that one of the delightful results of this weakness of the Deutsche Bank, that it could be taken over by a large British bank, which a large healthy balance sheet. There's a couple of them come to mind, HSBC or Lloyds. And therefore that would immediately solve the problem of British access to the European Union after Brexit. Just a thought. US GDP. The piece that I wrote during the week was actually based on a question from an institutional client in June. And at that point, the Chicago Fed National Activity Indicator, which all the clients watch because I've been talking about it for years, slumped to a low level. And the question was, does that mean that the US economy is in recession? So I thought, no, it doesn't. You know, that's still positive GDP growth. But I thought the way of demonstrating that would be to show a simple model which translated what the Chicago Fed National Activity Indicator says in terms of US GDP. And what I've done in the piece that I released during the week is I've translated that indicator into the way we in Australia talk about GDP in the terms of the Australian economy. That in the US they talk about in each quarter having quarterly annualised rates. So you've just heard, for example, that the second quarter had a quarterly annualised rate of 1.4%. And now we would expect, for example, the Atlanta Fed tells us and the New York Fed tells us that we can expect the third quarter to have an annualised rate of growth of about 2.8%. And the fourth quarter should have an annualised, the third quarter should have an annualised rate of 2.8%, the fourth quarter should have an annualised rate of 2.4%. But the way we talk about it is in terms of year-on-year growth rates. So I've shown this model in terms of year-on-year growth rates, the way we talk about GDP in Australia. For example, in the last quarter, year-on-year growth rate in Australia was 3.1%. Now, we think that this model is telling us that the year-on-year growth rate of the US economy is about 2.4%. Now, that's up from the second quarter, but not as strong as it might be in the third quarter, according to the Atlanta Fed, but as strong as you get pretty much the same number as kind of expected in the fourth quarter. And what that tells us is the US economy is now recovering. it's growing at a faster than the Fed target of about 2%. And because it's doing that, what we'd anticipate is a series of really good employment numbers for the next few months, and that will lead up to the Fed meeting in December. And therefore, we expect the Fed to take the advantage of those stronger than anticipated growth rates to increase the Fed funds rate in December. So the advantage of this model really is that we can update it rapidly. It has a slight lead to GDP. It gives you a good feel for GDP. It's very reliable. The problems with GDP readings, for example, in 2008, were due to the effects of international trade and inventories, whereas the Chicago Fed concentrates more on domestic production and employment and income and those kind of stuff. It's less knocked off course by international trade. So we'll show this model from time to time, and what it shows is healthy and improving growth in the US economy. Moving to fair value of the ASX 200, I updated this for a couple of retail pieces. Fair value right now in the Australian equities market is 54.50, which is near as bang on where it's been in the last couple of days. With consensus forecast of earnings growth, we expect that to get up to about 58.20 by the end of next year. But of course, that's entirely depending on whether those forecasts actually happen. Trump versus Clinton. I actually discovered an independent economic piece on their economic programs. This is done by IHS, which is the preferred consultant to the Congressional Budget Office, the non-partisan Congressional Budget Office. And the results are really quite interesting. The baseline forecast of IHS is very similar to the GDP model we were just talking about 2.4% growth for next year and the year after. And against that, both programs provide significant expenditure on infrastructure. So they both provide a boost, and the Clinton program increases growth from that 2.4% up to about 3%. In 2018-19, so that's a significant boost. The Trump program, on the other hand, expands growth to an even higher level of about 3.7%. So either of these programs provides stimulus, but the Trump program provides significantly more stimulus. Probably the difference from the Australian point of view is that the Trump program finishes with a larger US budget deficit. It expands the US budget deficit from about 2.5% of GDP to about 5% of GDP. And the effect of that on Australia, rather interestingly, would be that it would generate far greater stimulus in terms of our models for Australian resource exports, and it would drive the Aussie dollar up, I think, to about 85 cents. So the Trump program, however bad it might be for the Americans, would be extremely good for us.